But first, let me just go down the list here. We've got Todd Gardner of SAS Capital, Craig Hansen with Next World, and BJ Lackland with Lighter Capital. What we want to spend the next 40 minutes or so talking about is kind of the investor perspective on the cloud landscape and sort of enterprise cloud in particular. I want to give you guys each a few minutes to kind of introduce you and your firms and what you focus on, because what we have here right now is one VC and two guys who do debt investing, and so what they do is a little bit different than what we hear about and write about a lot in the media. We tend to be more focused on the equity side of the business. It's a little easier for us to get our heads around, but this is an interesting and important other round of or other approach to funding. So why don't we start with you, Todd, and just tell us what you do.
So my name's Todd Gardner. I'm the CEO of a company called SAS Capital, which is pretty descriptive. We're pretty focused. And I do think it's interesting that we ended up with two lenders and an equity guy. I think it does speak to some understanding that's happening in the marketplace that these businesses, once they've reached a certain level of critical mass, actually are very stable businesses and are good business models. So companies use our product typically in addition to, complementary to an equity round, or instead of an equity round. So they may have raised venture before, or they may be bootstrapped and use our facility, instead of Series B or C, as a way to continue to grow their company, fund it, and increase the valuation without the dilution.
So you mentioned Series B, C, which gives me some indication of kind of the stage at which you're investing, or do you have a criterion?
Yeah, and the guys from Lighter come in a little earlier, and I'm sure they can speak to that, but we're more growth stage, so, 2 to 3 million in revenue, 250K in MRR, and it's a line of credit product, which is the availability is driven by the MRR of the portfolio companies. So as they grow, they have access to more capital, and it's usually over a 2-year commitment period. So they can draw the money down as they need it, and they have more and more as they continue to grow. And most people are using it to do the obvious things, which are invest in new product development, sales and marketing, anything to help grow the enterprise.
Okay, cool. Thanks, Todd. Craig, how about you?
Hi, so thanks for having me. I'm Craig Hansen. I'm a general partner with Next World Capital. We're an expansion stage venture capital firm headquartered here in San Francisco. We also have offices in Paris and Brussels. We focus on both the enterprise and the consumer side, but a lot of our background, a lot of the companies we can chat about today are on the enterprise side. Being in the expansion stage means we're not the typical early stage guys, but we'll come in after that, typically as these companies are starting to hit the beginning and kind of early rough part of that hockey stick growth. So we'll help out and roll up our sleeves on sales and marketing growth, operations, hiring, strategy, all the components that really come into play as you hit that more accelerated growth curve. We do a lot of that in the US with our companies, and then through our European heritage and our offices over there, we also help companies make the leap abroad. So we spend a lot of time doing everything from the strategy to the advising on how to make the jump over to Europe, how to access international markets, all the way down to introducing people. So we run a business development network in Europe, specifically for our portfolio companies, and introduce them to the CIOs, CTOs, or other VP and upper level execs at most of the large companies in Europe. It's just one of the ways that we'll come in as the expansion stage guys and help them out. So some of our companies in the cloud space generally, Dynamic Ops was one of our companies that was sold to VMware last year. Good Data is one of our current companies. Host Analytics is another SaaS play. And then one of my earlier SaaS companies from a prior fund just went public a couple weeks ago, which was Rally Software.
Congrats. Cool, congratulations. Yeah. All right, BJ.
I'm BJ Capital.
Lighter Capital.
BJ Lackland, CEO of Lighter Capital. And what we provide is capital as a service is what we call it. We are actually a software development company and an investor. So we actually have an online loan application that we use to quickly screen companies. So we're actually a tech-enabled lender. We will take an online application from a company, be it a SaaS company or there's some sort of other online business, and we will fund companies in as little as 2 weeks. We've done several deals in as little as 2 weeks. What we provide is sort of a unique loan structure. So we do go earlier stage than SaaS Capital. What we look for is a minimum of about 15 to 20K per month in revenue. Sometimes it's a mixture of professional services that are going along with an implementation of some sort of SaaS product. We'll do both B2C as well as B2B. And we will then lend against that set of revenue in a unique structure called revenue-based finance. What we do is we give the companies typically several $100,000, and they then give us a percentage of their revenue until they've paid us back a multiple of the value of the loan. So typical loan would be, say, $250,000, and they would pay us, say, 5% of revenue until they pay us back a total of $500,000. If that takes 2 years, we've made a really good loan, and the company's probably grown dramatically quickly, and they're excited. If that takes 7 years, we're not doing much better than a bank. But we do that very quickly and at very high volume. So we've done 30 deals in the past 24 months or so, and we're rapidly ramping that up. We'll probably do 30 more this year, hopefully 100 or so next year.
That model of taking a percentage of revenues is one that I haven't run into a lot. Are there other people out there doing this kind of thing?
There are other funds doing it. They tend to be focused on a very different segment. So they'll be focused on like an industrial segment or something like that, and they'll be looking for companies that are doing 20 million in revenue, and they'll give them a $5 million slug of debt and then take a percentage of revenue from it. We're the only ones I know of that are really doing more focused on tech and doing sort of smaller deals like we are.
Okay.
And that's partly because we're actually a C Corp. We're not really a fund. I mean, we have a fund that we manage, but we're really an entity designed to scale this up and do it at much higher volume.
Okay. So I want to come back to the mechanics of investing in a little bit, because I think there might be some good discussion we could have around that, how to decide what kind of funding you need and how to get the attention of guys like you. But I want to start with sort of a broader question about the investing climate for enterprise cloud stuff in general. You know, as a journalist, every year we go through this exercise in like late December where we try to crank out stories about what happened the year before and what's going to happen in the year to come. And this is partly to just fill up those dead weeks around Christmas and New Year's when nobody has any news. But it's also partly to, it's a good exercise because it gives you a chance to kind of review what's going on. And this year was really easy to do that sort of on the cloud side, because it was really clear that all of a sudden people were really jaded about consumer investments, and the VCs were all like getting really fired up about enterprise stuff, and the enterprise is sexy again. So it was very easy to make a prediction. And sure enough, we were right. Like, it does feel like the enterprise is sexy again. Can you talk a little bit about why that is, kind of what led to that and what's going on?
Yeah. Well, I
Go
can start
ahead.
off with a couple of comments. You know, I think there are a couple of things. One is just an investor sentiment wave, and then another one is just the sector's growth itself. So from an investor sentiment stage, you know, no surprise, it goes through different cycles, right? Where people are looking at and excited about different things. And I think what people came back to realize, which, you know, we've tried to be focused on consistently over this, is, hey, there are some very interesting enterprise businesses where the value proposition is rock solid, the metrics make sense, and there's real underlying demand, and selling to enterprises is something that's tangible, and it's oftentimes more sticky than the consumer space.
Yep.
You start building it out. If you have a distinct competitive advantage in, say, a cloud infrastructure company, that does not go away overnight because somebody else releases some new app, right? There's more entrenched or hardcore competitive advantage. So people come back to liking that. People come back to the predictability of the SaaS side as an example. So that was one aspect that helps. And then the other, I think, was just the continuing maturity that we've seen in the cloud space. And I think you see this on both the infrastructure side and on the app side. On the infrastructure side, we keep going through different waves, right? Early on, it was predominantly, almost entirely an Amazon game. Now you're looking at a lot of different options, looking at some very interesting changes in adoption in open source alternatives, in hypervisor agnostic solutions. there's some interesting models going on in there, but then also on the application side, we've kind of moved from the earlier days of when we were trying to sell SaaS software solutions to companies. The general argument was usually we're 70% of the functionality, but we're a whole lot easier to use, and you can pay for us over time. And so, that's the trade-off. And for a certain number of the segments of the customer base, that made sense. And really, where I think we're getting to now is that SaaS as a business model has become mainstream.
Yeah, well, it's so
People
mainstream
accept
that you'd almost be foolish to launch a software
You
product
can't.
now that you'd
I
have
think
to
that's
install,
exactly
right?
Right. You
Yeah.
can't get funding for it.
Look
Yeah.
at for application level companies. Look at how many VC companies are getting VC backing that have a traditional on-prem model. It's hard to find. You almost have to explain why you're not a SaaS company in this stage.
Well, it's probably going to take a lot more capital to fund that as well. I mean, if you
Yeah.
can develop it and go launch it out on Amazon Web Services or Force.com or Azure or whatever, it's going to be a lot cheaper. So you're going to go to a VC or one of us and say, hey, I want a lot more money to do something that somebody else is probably going to do a lot more efficiently and do it in a futuristic way. And we're going to say, that's interesting, thanks, bye.
Yeah, and from a functionality standpoint, you kind of move beyond that 70% argument to, I think, where companies got to parity, to particularly with some of the companies we're working with now, like a Good Data or Host Analytics or others that are out there in the market. They've reached now a beyond parity point, where it's not about arguing that, hey, you're just as good as the on-prem guys in functionality. What we're really pushing these guys to emphasize are those things that they can do as a SaaS company that you simply cannot do with an on-prem model. And so that's
Yeah.
the starting point.
Right.
Collaboration, automatically feeding in all kinds of data and auto-populating that. You just can't do that with the other models. So that ends up being a killer combination to message.
So most of our portfolio companies and the SaaS companies that we talk to, they're updating the software once a week, once a day, and so that has completely overtaken the on-prem's capabilities to just keep up. And I think, another point that was made that I'd just like to reemphasize, sort of you just saw that hype cycle on the consumer side, and it can go away. And we just did some research the other day, and we had 200 SaaS companies respond. 70% were at 90% retention or above. And that's an important underwriting criteria for us, so we look at that really carefully and sort of dig into it. So it's growing at 30 or 40%, and it's safe because it's going to be there the next year and the next year.
I just want to make sure I got this right. 70% of the companies you surveyed have a 90% customer retention rate?
Or above, yeah.
That's amazing.
Yeah. I think people lie a little bit about guy who's in the audience from Tatango. He's like, I think they lie. And I'm like, I think there's a little bit of fluff in there. There's a lot of round numbers,
Yeah.
90% retention, 85% retention.
That's an annual rate?
Yeah, so it's, of the
Wow.
customers we had last year, we have, if we had 100, we have 90 of those still around today. And that only happens in the enterprise, in larger enterprise companies. And the smaller the customer base, you're getting down into the 80s if you're serving the SMB.
Yep.
But that speaks a tremendous amount of value, right? That's going to be a recurring cash flow stream. That's not going to go away. They're not going to miss their revenue numbers on Wall Street. And I think that's feeding back into, just the strength of the business model.
We see that exact same thing. Even at earlier stages, that the companies that are enterprise focused will keep those customer sets. In fact, a lot of them, they literally are like, because we're looking at them, they're pretty early. Like, have you guys lost many customers? And like, well, one went out of business, and like, that's about it. Whereas on the consumer side, we will lend to consumer-based companies. We'll see 50% churn rates. We just had a company apply at a 50% annual churn rate, and that's not uncommon. On the enterprise side, you never see that. Not if they're decent.
Yeah. So. I mean, it seems like some of this interest in the enterprise and cloud-based enterprise stuff specifically is just a reaction to the kind of like, how many Pinterest clones or completely unmonetized photo sharing apps do you really want to back, right? I mean, only one of them or two of them is going to turn out to be the category killer that sells to Facebook for $1 billion, right?
Yep.
And once that's done,
And so I think SaaS has all those vertical markets, right, where there can be literally thousands of successful SaaS businesses. There won't be thousands who are doing the horizontal plays. There won't be thousands of Workdays and thousands of Salesforces. But each little vertical market out there has 1 or 2 SaaS companies that's 3 to 15 million, growing at 10, 15, 20% a year, and those can be very successful businesses. And maybe when we get into the discussion around how those get funded, they might not be venture opportunities, but great businesses for the founders and offering good value to their individual vertical markets.
Yeah, that's true.
Well, we might as well talk about that since you brought it up. I mean, it's a good question. Like, you hear VCs talk at panels like this, and they're always saying things like, I don't know if you say this or not, Craig, but they're always saying things like, if you can't be $1 billion business, or if you don't have a shot at being $1 billion business, I don't want to invest in you, right? Paul Graham has this idea that the value of a company is proportional to the percentage chance that it's going to be, if you're investing, I don't know, 100 million in a company, it's because you think it has a 10% chance of becoming a $1 billion business. Yeah. My math is not right, but you get it. You get the idea.
Yeah.
But is that not the only way to look at things?
I think, well, to frame the VC perspective, then I'll turn over to these guys, which I think does open up the aperture more. Yes, in general, the venture capitalists are looking for very big plays. When something works out, you want it to be a momentous enough company that handles the capital. That said, there are still within that different ways to approach venture capital backed companies. And there's different return profiles depending on whether or not you're investing at the early stage or expansion stage or late stage, and how much capital you put into it. So, what we've seen is this this cyclical trend, and I think we're at a higher point now, where companies are taking much bigger equity rounds than they used to. So, if you used to see a Series B be 10 million and a Series C was kind of 15 to 20, now you're seeing some round sizes that are 2x that in some cases. And what that does is it's great in the short term, and for the right companies, if you have a fully productive use for that capital, it can be the right thing, but it's not always the right answer. And what it does is it really pushes up or puts stress on the hurdle that you have to have a big exit. So now all of a sudden you've said 100 million or over $100 million in the company. You really have to be going for that big exit, and nothing less works for or is likely going to get voted for by your board. So it puts stress, but it doesn't have to be that way. There are models that are a little bit more capital efficient on venture capital and varies by sector. We had a company that was sold last week. NextGen Storage was bought by Fusion.io, and NextGen had raised $12 million. It gives you a lot of flexibility and a lot of, frankly, upside for a fantastic return in that type of scenario. So yes, in general, the VCs have to look for the big play, and ultimately, out of all the companies out there, of great, fantastic, productive companies, it's still a smaller subset that truly makes sense for venture capital.
Right.
And there are other more creative avenues.
And I think there's venture in the valley and there's venture not in the valley. There really is. There's the rest of the country. And,
people ask me, are we in a bubble right now? I'm like, well, yeah. So
you've been in one a while, so there's both, I think, the creative use of debt to be more equity efficient. And I think there's also better examples now of companies that have been able to bootstrap and do a small round and then do a debt round. And then, we have portfolio companies that are 15 million in revenue and they've built it off $2 million in equity. And it's going to be a great outcome, for everybody. It took longer to get there, right? That's one of the equations. But the management team is the same, founding management team. And so there's lots of, there's not one right answer here. And I think too much equity can actually destabilize a business. At the same time, BJ and I can't fund the next Salesforce, right? You can't do that all on debt. And so I think you have to be realistic about what you're going after and what's a good outcome and how big can your company be without trying to turn it into something that it's really not.
Too much equity doesn't sound like a problem to me, by the way. How does it destabilize a business? Apart from the valuation issues that Craig was talking about.
Well, those are the issues. Because it's like, look, we need to get to here, right? And
now you got to live up to.
And honestly, the venture guys are never going to go, oh shit, we missed it. Right, you can never get this big. They're going to say, well, we need to execute better. I'm paraphrasing
Right.
some board meetings, but so there's tremendous pressure on the team, right? And also remember they sold equity to get there. So you've got management teams who are working off a smaller piece of the pie. So financially, it's not destabilizing because equity is the most solid core source of financing you can get. You don't have to pay it back. But the expectations that it can create are much higher, and sometimes that's great, and it has tremendous outcomes. And if you look at the all the public SaaS companies, a great preponderance of them are venture backed, but it doesn't work in all situations.
No, it's very specific. I was a VC for 5 years, and you approach it very differently. We approach, I'm sure probably Todd, you guys do. We approach the companies that we're giving loans to in a very, very different way than I approached it as a VC. As a VC, you're designed to swing for the fences, and you need to put as much capital to work in the winners that you can. Like with our model, and maybe with SaaS Capital too, we're designed for the solid bunt, right? It sounds kind of strange.
And sometimes it goes over the third baseman's head, and you get a double, but you
exactly,
never know.
And that's about
Sometimes
it.
you need a bunt, right?
Yeah, but we live on the singles and doubles, but we never strike out. So it's a very different sort of model of companies. We will never hit a home run, almost by design.
Right.
And a lot of the entrepreneurs we're funding, that's not really what they're looking at. They're looking for a personal home run, don't get me wrong, but they're not looking I'm going to go make the next Facebook or even the next Instagram or anything like that. They're saying, I've got this cool business, I've got $1 million in revenue, and I want to grow this thing up to 8 or 10 million and sell it off, and I'm going to own 80% of that when I sell it. And that's what's important to me. And as opposed to the VC model where I'm going to own 10. And I still got to pay all my preference and everything after that. But I might have a shot at making a $500 million business.
Now let me ask you, there's a lot of talk about the Series A crunch, right? Where because there have been such copious amounts of seed capital, angel capital out there, we're now finding that the number of companies that can actually qualify for their first institutional round is far bigger than the number that are actually going to get it, right? Are you seeing increased number of people from that pool?
Yeah, we see a decent amount of that. We see our typical borrower, typical customer has put founder money in. They've maybe gotten $300, $400, $500 grand of angel money in, frequently not VC money. Very few situations where we've seen actually VC money come in and we come in. It's typically founder money and angel money. And then they've thought, hey, should we go out and get venture capital? Sometimes they don't want it for the reasons we were just talking about. But a lot of times they're just I don't think this business model fits. I've got a $100 million opportunity. I don't have a $5 billion opportunity. And so they've been sort of looking around for something else, or they've gone out and they've talked to some VCs, and someone has been nicely told them, you're not really a VC-backable company.
We have a company here, Liquid Planner, who they actually skip A. With our help, right? So that's the hole that we plug. So this is actually good for the later stage guys, right? Because there's not an inflated cap table. There's not 6 VCs on the board already. And their plan is to go raise a Series A, but there's a good chance they'll do that when they're twice as big, maybe 3 times as big, and it's not as dilutive. So we're getting some of that business. Some of our companies wouldn't have qualified for it. But then others are choosing just, hey, this works for me now, and we'll go raise it later.
Yeah, we've seen that as well. Companies that, we'll see them and fund them after they've had an angel round. They'll grow up and get to, 5 million in revenue or something like that, and then they're starting to look around for their first true large equity round. By the time they're getting 5 million in revenue, and they're break even. They're saying, okay, I think I do have a bigger shot, so it's time to go out and get a slug of equity and kick this thing into high gear.
Yeah, I think that's an interesting component to the good question you framed, Dylan, which is, is it equity or debt? A lot of times it's both.
Right.
And in different combinations. So a lot of times the companies we're backing will see equity, and then we'll bring in debt guys. Or in some cases they'll have that. It's a great way to extend things, particularly if you've got product release cycles or interesting steps that you want to do. Then selling more equity, particularly if you're trying to do a very big round of equity, you're selling it at a discount to what you could be in the future. So you're wiser to take a reasonable amount of equity that gives you that equity type cushion and fuel to go forward, but then it can be a great complement to bring in debt and extend the runway with a little bit cheaper capital that way.
Okay. So I think, Todd, you mentioned sort of the hype cycle, kind of goes up and down. I want to go back to kind of that, notion. Where are we at in the hype cycle for SaaS and kind of enterprise cloud companies? Are there sectors that are getting overhyped now that you're starting?
I have a chart that I think everybody in the room probably has, which is sort of enterprise value by growth, right? And so I had that chart for a long time, and then Workday came along, and I had to completely resize the chart because, wow, so I think there's evidence in the public market of a little bit of frothiness, but I think you go back to this business model. I live in Cincinnati, right? We don't get hyped that often, right? Our real estate prices never went this high, and so they didn't crash to here. So I think that's part of the enterprises. I don't think the valuations, maybe except for Workday, although there's reasons why they're valued that much, are dramatically overextended. I don't think we'll ever see them swing like they did in the consumer side because the business model is so rock solid. I don't, and we just plug along. I mean, SaaS just keeps plugging along and growing at, 15 to 30 to 40% a year. So I don't feel like it's frothy. If I was a VC, I'd like to be selling now as opposed to buying maybe, but you don't always time it that well, and I don't think it's going to go dramatically in either direction.
Yeah.
But I'd be more interested in your opinion because we're lenders, right? And so it matters to us a little bit less.
No, I think that's right. Because of the fundamentals of the business, all the good aspects we talked about, you've got a little bit firmer footing, right? The business doesn't go away, your value proposition doesn't disappear or change with the fad or propensities of people. But then there's always a question, okay, well, how much is this size company at this growth rate worth?
Right.
And even if you just look at the public markets, it's backed up by the private data. There is a cyclical aspect to those valuations, and valuations today for SaaS companies are significantly higher than they've been in the past. So does that mean those companies are not worth it? In a lot of cases, the market opportunities are opening up, so you've got a bigger potential opportunity for these companies. But I think you have to, as investors and as company executives, because this is ultimately what you have to own up to and be able to achieve upon, you also want to keep in mind that, okay, those multiples could and historically do fluctuate. So don't leave yourself in a complete bind. And what it may mean is, okay, if you invest at X multiple and it goes down to half of that 3 or 4 years later into this, when you've got, say, some sort of liquidity event, you just have to cover that by the growth.
Yep.
And so it can work if you've got the growth and if the market's opening up, but you have to be realistic like that. It's not that hard to chart out the historical examples of SaaS companies specifically or software companies more generally and see that, okay, things are at a higher point now. So you need to be smart about what you're doing.
But we don't have that many cycles where there's been a ton of public SaaS companies. So to some degree, the market's now just figuring out, wow, this is a really good business model. I mean, they were not getting the premium they deserved, I think, for a while.
Yeah.
Now, is there too much premium or not? I don't know the answer to that, but I think part of it is just, wow, these are really good companies.
I mean, recurring revenue has always been popular on Wall Street, right? I mean, companies with recurring revenue have always been popular in any sort of business model you'd ever looked at. And it's like they sort of finally figured out that SaaS has this wonderful recurring revenue model that we all know about. And that's why you're seeing, I think, in part, I mean, there's a lot of hype and other things too, but that's in part why you're seeing that, like, Salesforce is at an all-time high, Concur is at an all-time high, their stock prices, I mean. So that drives a lot of these valuations. But, I would echo what Todd said, that as a lender, we're not nearly as sensitive to it. Like, it means a lot more to you guys on the equity side, obviously, than it does to us.
Okay. We can take audience questions. So if you've got a question, stand up and look for a mic. Wave your hand. I can't see very well. If you have a question, I'm going to ask a question in the meantime. We'll come back to the audience in a second. Oh, we have an audience question right there, right behind the camera here. Wait for the mic, though. He's almost there. There you go.
Hi, Phil Wainwright. I'm just interested to see that we're talking about VC and investor outlook, and two of the people on the stage are actually doing lending rather than VC investment. So, I mean, does tell us that the VCs are chasing other stuff, that they're not really interested in SaaS, or does it tell us
busy
that?
today.
Yeah, and one of the VCs didn't even show up, so
Well, yeah.
is that a sign?
Closing the big deal right now.
Or is it just that SaaS companies are too savvy to take VC money? They've cottoned on to,
Yeah.
I think it's a
what
model
economy it is.
that, sorry, go ahead. I think it's a model that lends itself well to lending. Sorry for the pun, but it lends itself well to lending because you've got such a solid set of revenue streams that tend to just simply stack on themselves. And so it's a great model to lend against. It's very predictable. It's very easy for us in our software system to look at a company and say, okay, your customer addition rate is X and your customer attrition rate is Y, and at the rate you're adding, you're going to do this. And especially for us, we don't invest in companies that are losing a ton of money because we don't like to take on financing risk that badly. So we'll say, okay, you're going to take our money, you're going to go run a Google AdWords campaign or hire a sales guy or do something like that, and you're going to try and even increase that customer addition rate. But it seems like sort of almost trite to say, but it's a pretty simple thing to model out how that is going to work out. And obviously, things happen in life and things can change, and the product maybe isn't as good as they thought, or their attrition rate increases or whatever. But generally speaking, these companies, because it's SaaS, you can measure it, they tend to decrease their attrition rate. So it's a pretty solid model to lend against in a way that I think software companies of old simply weren't.
Right. You could start a whole fund just focused on lending to SaaS companies. That'd be a pretty cool thing.
Yeah, you can maybe call it.
Phil,
SaaS
I think it's very healthy, right? I think the venture community is very healthy in SaaS. For all the reasons that we mentioned, and I think there is alternatives, and there weren't for good reasons in traditional software businesses because the revenue and the cash flow streams were so lumpy. So it might put a little pressure on the VCs, but I think people are finding a way to mix and match the two, and it's better for the company.
Yeah, you see a lot of press about, is venture capital dead or it's ripe for venture capital is not going away. Yeah. Like we cannot lend you enough money, nor can Todd, I think, to go and build, like we said, the next Salesforce. I mean, that's just not going to happen. These are, I think, additional financing possibilities for companies that aren't as available in other industries because of the way they're structured, partly, but venture capital is not going away anytime soon.
I will certainly say from my perspective, covering the tech industry, I don't, and a lot of the deals that happen in the industry, I don't see any decline in VC interest in the cloud or in SaaS at all.
Yeah.
Still quite hot from my point of view. Any other audience questions? Yes, we have one right over there. Microphone's coming. Yes, there you go.
Okay, right. Is it on? Can you hear? Okay.
Yeah.
So right now it seems like the multipliers are based on growth and churn and not a concern at all about EBITDA or profit. Do you guys think this is going to continue for 5-10 years, or are we in another kind of different kind of bubble?
It's a good question.
Yeah. So from the equity standpoint, it depends on the stage of the company. We'll start looking for EBITDA break even and start looking at those as metrics later on in the growth of the company, and then actual GAAP profitability even later than that. But yeah, for a lot of the typical VC financing periods, say Series A through D or E, yeah, you're looking for the growth rate, you're looking for the ability to efficiently acquire those customers, and then you're looking for the engagement and stickiness metrics. So you pay high premiums for those things. If you're something that's growing very quickly and you're able to retain and engage those users, and you're able to make that monetization make sense and make profitable sense in the short term, right, that's great. That gives you a lot of the fundamentals. The rest of it, are you going to be able to build the rest of your OpEx in accordance? Are you going to be able to have reasonable gross margins? If you keep those things within the typical bands of SaaS companies, you're going to be fine. So it ends up boiling down to a handful of top-line metrics. That's why you see people paying significant premiums or discounts depending on where you fall on that growth, retention, and efficient acquisition curve.
Yeah, the only comment I would make, if you're not growing, you need to be making money. I mean, you need to be in one camp or the other. But if you're growing, you're sub-optimizing your opportunity. So you're growing, you have access to reasonably cost of capital, then the math's easy, right? You grow for as long as you can, and the public markets are even giving you a pass on profitability because they now understand the model a lot better. And they're like, last time I did the research, I don't know if it's the same now, 3 of the 5 biggest market cap SaaS companies were not making money, right? And it's because Wall Street's, they figured it out that, boy, they can start cranking out a tremendous amount of cash, but let's make the cash machine as big as we can before we start doing that.
More questions? We have one right here in front, I think. Right in front of you, directly, yeah, right there.
I could ask this question a couple of ways, but I'll ask it the polite way, which is EBITDA a good metric or a bad metric, and why?
Oh, I've got a thought on this. I'm sorry.
A good metric or bad metric for what use?
Does it actually correlate with anything? In other words, isn't that just another way of saying earnings before those things that would make earnings look not so good?
I think EBITDA is actually a decent number for SaaS companies. First of all, there tends not to be much depreciation, amortization, or interest expense, right? So I actually think net earnings aren't, positive or negative, a bad proxy for how the company's doing. What you'll see is the argument against that is, hey, you just need to look at bottom line cash flow. And a lot of companies are cash flow positive, but earnings negative. And that's because they're adding customers quickly and they're getting a year in advance, right? And that creates the positive cash flow. That's great while you're growing, but you are not a steady state cash flow positive business. That only happens when you hit the EBITDA or net income positive. So we do look at that bottom line because we're lenders. We're looking at some of the downside scenarios. And so what if you stop growing? How much cash can you throw off? But I don't know if that answers your question specifically, but I think it's not a, people are like, oh, GAAP doesn't matter in SaaS. I don't agree with that. I think you can look at a P&L statement and have a pretty good sense of, how the company's doing.
I think, listen, GAAP still matters as accounting. We all have to have a standard for it. EBITDA specifically, like you said, there isn't much it or da. So in these things, if they're not,
There's never taxes.
A big profit,
Right.
So, the only I in there might be, interest you're paying to one of us as a lender or something like that. But so you're really looking sort of at earnings. We really look at a lot of cash flow. We look at cash, right? So if you are, like you said, if you're growing, you can run negative profits for a period of time as long as you're growing and have that cash there. And when we're looking at it, because we are a lender, we do look at the bottom line. We also look at basically like what's the scale back plan? What's sort of plan B? If you guys don't hit the revenue run rate that you're expecting to get, like how are you going to scale this thing back and be okay? So from our perspective, we can get paid back, but also from the company's perspective, that survives.
Right.
And with SaaS companies, it's another reason why it's a great model to lend against, because in general, it's pretty easy for the companies to scale back. You're like, what's your scale back plan? They're like, let go of some sales and marketing people. And we'll just grow more slowly. Instead of growing at 75% a year, we'll grow at 25% per year. And so it is really important. We're a lender, we look at cash. So.
Cool. One more question, yeah.
Just one more. And I might have missed this early on because I was a little late, but curious to know, when you do the lending, are you also taking a convertible debt position or is it straight debt?
Well, we have different products, but I think they're both straight debt.
Yeah.
So we're both senior secured. We're charging more than the bank. I think we both take a small warrant position.
Yeah.
But not, convertible is a whole different.
A whole different ball of wax.
Yeah.
So no, we're sort of a hybrid security, but not hybrid in terms of your classic convertible debt piece. And we don't, we take an equity kicker, but we do not convert.
Convertible debt is way more prevalent than it was just a few years ago. I barely heard that term 5 years ago when I was covering this.
Are you seeing
think
are
it's
the
a
angels
lot
guys
more.
It's
doing it?
angels.
Yeah,
a lot
yeah,
of times
right.
it's angels.
Right.
So angels and the incubators like,
Yeah.
you know, a Y
Combinator and such. So you see a lot of convertible debt with that, which then ultimately gets converted if they do a round. And this gets back to the series I crunch a little bit, we see some convertible debt that's not yet converted because they haven't gotten to an equity round and they're looking around for something else because they're either having a hard time closing it or just don't want to get the dilution that they or fear they're going to face. So we'll see some convertible debt on things, but it's convertible debt that was put in with the idea that it was going to convert into equity. Those are really equity investments put in a protective shell.
Right.
We're not. We're straight debt. Does that make you guys nervous? Like when you, Craig, in particular, is convertible debt? Is that like a red flag for you at all?
No, not really. It's become pretty commonplace, particularly if it's an earlier stage round. You know, there's a difference between some of these guys going in with convertible debt because they don't want to price the round, they don't want to overly complicate it in the early stages, so it increases the velocity or ease of that investment.
Yep.
As opposed to prior more traditional uses of convertible debt where it was more of a bridge loan aspect. Right. And you did it because, so the difference is, you know, are you doing it because you don't want to price it and because convertible debt is the right structure, gives you a little bit of downside protection, or are you doing convertible debt because you don't want to own up to what you think the valuation is going to be, in which case, you know, it would happen, it would be a little bit more indicative of a company that had a stumble or had something. So, but in most cases, when you see convertible debt today, it's not that kind of a red flag. It's fairly typical, and then you just convert into the new equity round, reasonable terms, traditional equity investor prices around, and then the cap table is clean going forward.
Yeah, by the time they get to you, probably you don't even see.
Yeah, I mean,
And he has
with the
reasonable
round,
terms.
it's clean up.
Yeah.
All right. Well, we're all out of time. Thank you, gentlemen. Todd,
Great.
Craig,
Thanks,
and BJ for joining us. I really appreciate the discussion.
Thanks.
Thank you.
Great.